All right, we are back here at Market Watchers Live. I am going to be doing a workshop today on momentum indicators. I'm going to give you kind of an introduction. I've got some great charts to show you with some examples. Excuse me. So let's go ahead and dive right in, and I'll explain to you some of the things I'll be covering. So of course, we're going to look at the definition of momentum, and we're going to cover the common momentum indicators, the rate of change, the RSI, stochastics, MACD, and PPO, and of course, my favorite, the price momentum oscillator. So we will look at all of those and some examples. And I also set up a chart with all of them on it, just so you can get a feel for, how these are similar and how they're very different. And let's go ahead and start with our definition. So momentum really is as simple as this. It just analyzes the changes in price instead of levels. It's just right up there, what's the change from yesterday to today? What's the change between last week and this week? And that's technically what the definition of momentum really is. And so momentum gives you the speed, the movement, and the rate of ascent or descent. So you're looking at kind of a picture of what happens on your accelerator. When you start pushing down on the accelerator, of course, your speed starts to move, starts to go up, your movement is moving up, and then your slope, or what you're doing with your accelerator, you're pushing further down, and that's your rate of ascent or descent as far as the momentum goes. So hopefully that makes some sense. It's also synonymous with slope, because again, we're looking at the rate of the ascent and the descent of your acceleration. So if you remember from your algebra calculus days, it is the slope when we talk about a Cartesian plane on a piece of graph paper. It is also known as rate of change. So we talked about the change in price versus change in price levels, but momentum truly is just the rate of change. And that, of course, will be the first one that I'm going to go over. One thing to understand is momentum indicators typically are leading indicators versus lagging moving averages. So when you look at the moving averages on your price chart and the crossovers, or where the price is in conjunction with the moving averages, they tend to move slower. They have to take in account a lot of data, more than likely. And so they just tend to move slower, and looking for crossovers and that sort of thing, you a lot of times are going to get in late if you're just going strictly by moving averages. This is why with the decision point analysis process, I always include not just price and moving averages and their crossovers for our trend models, but we also follow the momentum of the price momentum oscillator. And adding all of those in, moving averages and momentum, it does give you a pretty good picture of what's going on with the stock. And of course, you add the OBV or volume to your charts and you have even more information. So let's go ahead and we'll start with the simple momentum formula. So it is very simple, because what we're saying is we're looking at the difference between two prices taken over a fixed interval, or N days, however many days you want N to be. So momentum, price minus the price at that time, N days ago. So if N is 7, if that's or 5, that means 5 days ago or last week on Monday. You look at that price and subtract it from the current price, and that tells you what momentum is. And here is another example with 5 days, price minus the price 5 days ago, and that's the simple momentum formula. Rate of change, you can actually put this on your charts as an indicator here at StockCharts. And it's basically the same sort of thing, only we look at it as a percentage change, rate of change. So the momentum, of course, is your close minus the close on that day. But now we take it and divide by that close and then multiply by 100. So basically you're just taking the percentage of the rate of change over that many days. So for example, N, let's just stick to 5 days. It's pretty easy to visualize. So let's say the close today was $25. The close 5 days ago was $22. So momentum would give you a positive $3, right? So let's find the 5-day rate of change. So 25 minus 22, that's going to be your 3, and then divide it by the close N days ago, or in this case, 5 days ago. So we'll divide by 22 and we multiply by 100. And so our rate of change, 5 days, a 5-day rate of change was 13.6%. So, I mean, we figure this out just to see the percentage gain that we make. You know, that's pretty much what the rate of change is. So if you want to have that on there and know what your gains are over a certain period of time, you can look at least the percentage change over time. So here is the chart with the rate of change, and I put in the one that is the default is 12 days. And then I just added, just so you could look at it, the rate of change for 50 days and the rate of change for 200 days. So they have a similar look to them, do they not? Not exact, but they are, it just gives you a way to see what is happening with, you know, how much of a change is this from 12 days ago? You know, that's what you're looking at here. Changes passing through the 0 line, I think, is usually something we look at as far as a signal goes. I mean, those are still hit and miss. Again, I prefer my oscillators. I'm sure most people prefer the MACD or the PMO or the PPO. But this is just giving you a graphical version of what the rate of change looks like. The next one I'm going to look at is relative strength index. And there's a lot of confusion because of the name. A lot of people think that it's giving you a relative strength amongst its peers. It has nothing to do with that. You're looking at the relative strength of the price on a particular chart. So here is what we have. So you're measuring the strength by monitoring the changes in those closing prices. So again, this is still based on the price differences. Momentum is about price differences. It is a leading or coincident indicator. You typically aren't going to see a lot of lag when you look at this indicator. And again, this is why we tend to, most of us have some sort of momentum indicator on our chart. It is bounded, which is something very important with your indicators, at least in my opinion, because I like to, I want to be able to compare this actually across other symbols. So while this doesn't necessarily measure the relative strength of, you know, for example, Ford versus GM, it doesn't really give you that, but you can look at whether it's overbought or oversold because it's bounded. And in this case, you could actually make a comparison of the percentage of one RSI to another RSI, but it's really focused on what's happening with that particular stock. And being bounded is important, whoops, like I said, because you want to be able to look at overbought versus oversold. And if your indicator is not bounded, you can't really do that. Well, there you go for overbought and oversold analysis. Also, you can use it for divergences. You know, do you have rising bottoms versus declining bottoms on the price? That usually is an indication of something good, because your indicator has those rising bottoms, but your price at the same time is showing a decline. But you're seeing the momentum despite lowering price bottoms. You're still starting to see some momentum building underneath the surface. This is also does tell you whether the bulls or bears are stronger at closing time. And I say that because when you see the formula, you'll get the feel here of why that's true. So The relative strength index, or the RSI, is equal to 100 minus 100 over 1 plus the RS, relative strength. So this is the relative strength index. This is relative strength through the days. So average of the net up closing prices for a time period. So think about over the last 5 days, since we're using 5 on a lot of these, or actually we'll use 14 since that is the default setting. So over the past 14 days, what were the average of the up closing changes? So we only are looking at days where we had a close to the positive side for that 14 days. And then we look at an average of the net down closing changes for that same period. So think about all those down days, and you're averaging those changes over that time. And the RSI, the index, is calculated by, like I said, taking 1 plus this and dividing it into 100 and then subtracting. So that is how you calculate it. But just so you can visualize, I just wanted you to be able to sort of visualize over 14 days, average of those up closing changes. So let's say the net closing changes are about 2% over time, and maybe the average net down closing changes are 1%. So your relative strength there is going to be 2. 1 plus 2 is 3, divided into 100 minus 100, and that gives you your relative strength index. And here it is on a chart. And again, I used the default up here on the top, but I also decided to throw in some, larger numbers here for the number of days look back here for the RSI. And you can see as you get higher and higher, as with most indicators, they sort of start to smooth out. So again, what you're looking for are possible divergences. Right here, we've got lower lows here, but also lower lows on price. So you're getting a confirmation there. Let's see if we can find a positive divergence. I would say this probably is a positive divergence here at the end of June of last year. You can see the bottoms are sort of trying to rise right here, but look at what's happening with them over that time. They're moving slowly downward. And so that is a positive divergence. And we did end up getting a pretty nice move off of that divergence. Stochastic. Now, this is one, admittedly, I don't use really at all. I've studied it because I've had to study it for my CMT exams. But a lot of people do really like this. I just find it a little too complicated in my head to visualize. But I do want to go over it with you because it is one of the more popular momentum indicators out there. Excuse me. So it tracks the relationship of each closing price to the recent high-low range. So let's say here's your high range, here's your low range. And what it does is if your closing price is here, you're going to check the relationship to that high and the relationship to the low. It consists of 2 lines. The fast line is called the %K, and that's your raw stochastic number. And then there's the slow line, and that's called your %D. And basically, it's just a smoothing of %K. So that's why it's a slow line. Now, remember when we looked at that RSI chart, how each time you added to the smoothing, it smooths out the line. It starts to look, it starts to move a little bit slower. You'll see the more of the undulations from one to the other rather than, a real, a line that's going, you're getting a lot of twitch on it. So you slow it down. And in this case, they call it the %D. The range it is bound is from 0 to 100. So again, I do like to look at oscillators that are bounded because I can look at overbought and oversold. And in the case of the stochastic, there are actual thresholds that analysts use, and it's considered overbought if it's over 80, and it's considered oversold if the stochastic is less than 20. And, when your lines, both of your %K and %D are moving together, that suggests you're going to continue that trend. So if they're both moving together to the upside, that suggests that your price trend moving up is going to continue. So it's useful if you understand what you're looking for when you visualize it and see it on the chart. So how do we calculate %K? Well, %K is the close today minus the line, the low from however many days ago, and then you divide by the high for however many days ago minus the low for during a particular time period, and multiply that by 100. So that is your %K. And L, like I said, it's the lowest point for that selected number of days, and H, the highest point for the selected number of days. So if we're looking at 14 days, then the highest high is what you use for HN, and the lowest low over those 14 days is what you use as your LN. N being the number of days, typically 14. Like I said, that is the default. So step 1, we calculated the %K. Step 2, we calculate the %D, and that is the 3-day simple moving average of the %K. So like I said, we're smoothing out %K, and that's how you would do that. So next to be understood. So the fast stochastic, because you'll notice that you can use a fast stochastic or a slow stochastic or full stochastic on the chart. So a fast stochastic basically uses that original formula for %K and %D. It's very sensitive, and it does tend to whipsaw. The slow stochastic adds that extra layer of smoothing. And so %D becomes the %K of that regular formula. And then you take the, to make the %D, the %K line, it's back and forth. So you've got your %K line, which up here it was the %D, and then you smooth it one more time to get that new %D. And that's 3-day simple moving average of that %K of the slow stochastic. Unfortunately, they keep the same letters, so it does get a little confusing. But when you use the slower one, you're going to get fewer whipsaws. And that, of course, makes sense because you're getting that extra layer of smoothing. And here is what the stochastics look like. So there's your %K and your %D on the full stochastics. And notice when they're traveling together, even this is going upward, it's telling you that this trend should continue. When you start to see that turn, or you start to see one do something different than the other, that's when you start looking for those changes. And as you can see, it says that that trend would continue up through about October, and sure enough, the trend did continue through this movement to the downside. So that's kind of the tricky thing. It is overbought here, and it is oversold here if you want to look at it that way. But really what you're looking for is just these lines traveling together or not together. When they have maybe crossovers, that can be an interesting thing to study as well. But like I said, I don't really use stochastics, so I'm not going to get too into the analysis of it because it's just something I don't follow. Moving average, convergence, divergence, and the PPO. These really are totally related. The MACD is the difference simply between two EMAs with a signal line of the 9-day EMA of those differences. It is unbounded. The MACD is unbounded, so you really can't do your overbought, oversold analysis. There's no relative strength analysis that you can do. You can't compare one MACD value to another MACD value. And when you go into the long term, like a long-term daily chart, you can't see the MACD values for earlier in the previous years. It's just not visible. The PPO, however, calculates that % change in those values. So by doing that, you've now bounded it, and now you can get that overbought, oversold. Now you can compare PPO values to get relative strength. So here is a MACD and the MACD histogram as well. The histogram is basically a measure of the difference right there, so you can see it visually. And you can see when it starts to move down, that means you're getting closer and closer to the signal line. So that's what the histograms measure. I think they are pretty interesting. I'd love to get one on my PMO. But here you go. The PPO, as you can see, really similar. But the difference is that it is bounded. There is a range. All right, the price momentum oscillator, save the best for last. It is a decision point indicator that Erin Swenlin developed. I helped him a little bit with the algebra, but it was really his brainchild. It is a rate of change ratio, and you can use it for historical and relative strength comparisons. So like I was saying, the MACD, you can't really go back in time on a daily chart and see it, but you can do that with the PMO. It is very similar to the PPO, and you're going to see that when I show you the chart. You can use it for divergences. I follow the center line. You can use overbought, oversold. Of course, the crossovers are what gives us our PMO signals that I'm always writing about. All right, so it is, gosh, what did my dad call it? I can't remember that, it was just this really kind of an awkward way of coming up with a momentum signal, but it is different than the MACD. I'm not going to go through this function. I'm not going to go through this, but you have a custom smoothing function. So you have your smoothing multiplier, your function, and basically you're just taking smoothing of price times 100 minus 100. So it's just your smoothing over and over. And the signal line is a 10-period EMA of that PMO line. And here you are with what it looks like. And so I decided to put the PMO, this is our default. That's what I tend to use. I just find it for intermediate term trading to be the best tool for me. But you can also speed it up to use the same MACD calculation or default, and that speeds up the PMO. And I did write about this, I think, in Chart Watchers about 2 weeks ago, if you wanted to read up on speeding up the PMO. I do that for some of my scans more so. Notice you get some crossovers here that you don't get with the other ones, so you can get a little bit whipped around on your signals. Notice also here, never actually got that sell signal, but here we got a sell signal, and yet the price trend continued higher. So this is why I prefer these particular default settings. So here's that chart I wanted to show you how all of these compare together. So on the top, we have the full stochastics with your %K and your %D, PMO, MACD, PPO, there's your RSI of 14 days, and then there's a rate of change for 12, which is the default. So what I find interesting, and what I would imagine that you find interesting, is that tops tend to match up. They just come in at a little bit different times, but they do tend to match up here. And lows, it also tends to match up a little bit more so on, the MACD, PPO, and rate of change, more so than with the stochastics. As you can see, there's a lot of movement back and forth on your full stochastics versus, for example, the PMO with its default settings, which is very, again, it's a little bit slower. You get a crossover back here, but on the MACD, your crossover maybe happened just a little bit sooner, certainly sooner on the PPO. But again, you're speeding up your settings versus the PMO. And again, I like smoothing it out just a little bit because you don't get quite the whipsaw that you get with the PPO and the MACD when you have those faster settings. But if you're a short-term trader, sometimes that makes sense. All right, so this completes what we're doing, momentum indicators. These are the takeaways, just some things you might want to remember. I will have these slides up in the Market Watchers live recap for today, July 22nd, 2019. So if you wanted to go in, you can get a copy of these slides that way. So remember, momentum is just a speed of the price movement. It's really measuring the accelerator, what you're doing with the accelerator. It's the rate of ascent or descent. That was something I didn't quite cover. When you've got a flat PMO or a flat momentum indicator, that doesn't mean that price is moving sideways. For example, it could be flat if you're rising at the same speed. So you're not pushing down on the accelerator, you're not letting up on the accelerator, you're just maintaining that speed. So what's happening to momentum? It's evening out, it's flattening out. So that's one thing to think about. That's also why we look at some of those divergences. So the slope is what momentum is. Momentum indicators we went over, typically leading, not lagging. Measure acceleration or rate of change in momentum. That's what you're looking at as far as what a momentum indicator does. We look at divergences and the direction of those lines, especially with the stochastics. Oscillators, we can use overbought, oversold analysis. We can't do this on the MACD. But all the other ones that I showed you, you do have, they oscillate and they have a range. And then there are the defaults on StockCharts.com. So all of the chart that I showed you before with all of them on it, you can just go down and click on indicator and they're in there. And they are already set with the what usually works the best. So that's all I had, Tom. Man, I finished, boom, right on time too. I'm pretty impressed.
Yeah, and it was a good recap for anyone who maybe has wondered about, momentum indicators and how they're calculated. And I have to say, I don't pay attention to any indicators if I don't understand what they are and how they work, because buying and selling stocks and putting thousands of dollars, of your money to work based on a line pointing up or down, I don't think is a good idea. I think that I personally use these momentum oscillators as secondary indicators. I don't buy or sell based on them, but I do use them to confirm other things that I'm seeing on the charts. But I wouldn't use any indicator at all if I didn't know what it was, or, just the fact that when this line points up, the stock does this based on some other stock I've looked at. I wouldn't just assume that happens across the board.
Oh, absolutely. I always look at crossovers and that sort of thing as we call them with DecisionPoint attention flags. I use them for my scans because I should pay attention because I got a crossover, something's happening with momentum. So it brings my attention to a chart, but I do all of my analysis. I include the momentum, but there's a lot more that goes into it with volume and averages and price movement and all of that.
Mm-hmm. No, and I think that's smart. I mean, that's what you want to use. I mean, if you're a momentum trader, which a lot of traders are, I think momentum oscillators certainly are a tool that you can use to find trades. And even like the crossovers you're talking about, a lot of times if a company has its oscillators pointing lower, and especially if it's below the zero line and pointing lower, it's telling you the momentum's heading in the wrong direction. But when you get those crossovers, it could be a signal that things have changed.
Exactly.
I'm going to talk about how to use the volume by price option on stock charts. It's an overlay, not an indicator. And what we do is we put it right in the back behind the price. So in order to do that, we're going to go in under the overlay section. We're going to select volume by price, and it defaults to 10 bars. But if you'd like a little finer control of that, you can set the number of bars there by just putting in a number, and usually an odd number is better. But what happens is when you select that, it will draw out the bars, and you can see that clearly this current bar is one of the highest levels resistance or support. So this is a very interesting place for the price. Anyway, so remember, when you're using volume by price, it's an overlay, and you can select how many different bars you want to see on the left-hand side all the way up to 100.